Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.
Welcome to Sparta Market Outlook podcast, where we break down the latest trends and key developments shaping the global oil and energy markets. I'm Rachel Williams, and today we're diving into some of the major themes moving the market right now. So from the latest JODI data and China's refinery activity to shifting arbitrage flows and what's next for diesel, jet and gasoline markets. We'll also be discussing how the developments in the US, strikes in the Middle East and Russian refinery attacks are shaping trade flows and margins. So joining me today are Neil and Phil. Hi both.
Hello. Good afternoon.
Who will help us unpack these market moves and what they mean for the weeks ahead. So look, let's get into it. Kicking off as usual, why don't we do a bit of a recap of what we learned over the week. So look, the latest JODI data suggests a build in crude and product stocks in OECD, Europe and Asia. So should we be reading anything into this yet, Neil?
No, probably not. If I've done my little data update correctly, there's always a chance I've not. It was a fairly unusually strong build in combined OECD, Europe and Asia for crude and total products. But of course, I mean, you get these months, right? It's just 1 month. So the idea would be let's monitor that one. What else did I notice about the data? I thought the gas oil stock build in December was revised up, so the whole thing was slightly less bullish than one might have expected.
Okay.
And yeah, just to take note of it. On the other hand, does it change much about our view? No, because it's 1 month. I don't think there's really that much evidence in the general market that the big IEA kind of massive long 2025 thing is really happening. And if you look in the US, for example, in the weekly stats, that was a reasonably bullish report yesterday. We're recording this on Thursday.
Yep.
Total oil stocks are still drawing. Crude is building a bit, but particularly distillates is drawing. So it looks kind of bullish still from that perspective. Right, Phil?
Yeah. I was just going to ask on the JODI for January, kind of how complete is that already? I know that it's kind of the first issuance for January, and there's maybe a bit more data, so some revision to come.
Yeah, for the OECD, I think it's largely complete. I haven't checked it that much, but most of it's there for the OECD. Some guys didn't report in the Middle East, but that's a fairly
okay. So
fixed
it's right. Yeah. So it's a bearish report, but let's
see.
It's 1 month.
Yeah, let's see. So look, does this reinforce our expectation then that the IEA narrative will need a reality check, do we think?
Yeah, so that's just something I wanted to pick up. It's like one of these kind of longer term things to have in the back of your head. And it's something that we've picked up on the last few podcasts, right? So the market currently prices, I don't know if flat prices are pricing recession, but obviously it's going in that direction, right? Also gas oil cracks and also wider markets. And we're not there yet. And from the oil balance perspective, there's not that much evidence that inventories are particularly high or rapidly building. And I think the point is this is probably the weakest point of the year, particularly for crude, because we've got turnarounds. And the thing in the back of my mind is if we start to see some decent, hefty total oil stock draws going into the middle of the year, which is when you expect it to happen, then I think the narrative might have to change. And that's the type of play where the money is made, right? Because the market thinks about the IEA balance and now it thinks about recession. And maybe there will still be a reality check down the line.
Okay, so one to watch then over the next couple of weeks, and let's see what next month's JODI brings us. But look, there's lots of generally bullish things happening this week in the headlines. I know that you've got kind of a whole docket here of interesting pieces to talk about. So where are we getting to there?
Well, the first thing is obviously geopolitical. So there's the strikes on the Houthis. I mean, that's worth a buck or two on flat price. It's worth a buck or two on gas oil cracks, probably more specifically because it makes the chances of the Suez reopening much less likely now. And it was kind of ramping up over the last few weeks, and now I guess we should be of the opinion that this thing is not going to happen anytime soon. Is that fair enough, Phil?
Yeah. So pricing wise, and obviously it impacts the both the east-west on light and the middle distillates. And listening to our podcast from earlier in the week, the Singapore one,
it was interesting.
There was anyway kind of a little bit of hesitancy about exactly how quick some of the bigger players especially would re-enter the Suez route, and this obviously just maybe also takes some of the Greek owners out of it. And it's been interesting as well, especially on distillate. We've seen a lot more in terms of the larger vessel sizes going around the Cape. It seems as though there is now, one or two Suez or even VLs that are kind of on a semi-regular basis. Apparently, I haven't got the ship tracking to double check, but plying that route. So it looks as though there is kind of maybe a fairly well-established workaround anyway now to the Suez. So yeah, whether this setback has too much of an impact, we'll see.
Okay.
So sorry, it's not a big volumetric impact versus the status quo, right? It's more just about
exactly.
Yeah.
And to be fair, kind of we monitor both the Cape and the Suez and the platform, so there's options there for people to kind of look into. Look, sticking on the geopolitics then, Trump's pressure on Iran over nuclear deals, that's been in the news of late. So how does this change the risk outlook for the oil markets as well?
Yeah, I just think it's related. It's the same topic, obviously, largely speaking. And that's probably, particularly last night, that's probably where more of the risk premium is going to come on, because it's actually worth potentially a big supply change, right? The Houthi Suez route is more of a trade freight issue, but this thing with Iran obviously could, in theory, result in big changes to supply. We're not there yet, but it's definitely worth some risk premium at the moment. And the language is quite strong. Like, the language was quite strong yesterday from the Trump camp.
Yeah, it was indeed. So we'll keep a monitor on kind of the US news ever folding. Tariffs have been quite quiet this week, which is good. So looking ahead then to moving away from the US.
Just means next week will be less quiet again.
Yeah, I know, it will be chaos, I'm sure. But look, China, how are we doing there in terms of news coming out?
Well, I thought it was kind of, the data that came out was kind of supportive, right? So they had Chinese crude runs for January, February, because of course they released Jan, Feb at the same time. They were the highest in a year. I think imports were still down, so that there's the notion that they might have been drawing crude, but that might also be related to sort of supply chain issues with Russia and Iran, of course. So, but the initial signals this year suggest it's looking slightly more bullish from a Chinese crude demand perspective, and therefore potentially an imports perspective, particularly relative to January, February, which were disrupted.
Yeah.
So for me, that's quite good.
Yeah. How did that compare against kind of where we were seeing margins at the time? My memory is not great on this.
Margins. But margins have repriced a lot over the last few weeks, right? So I suppose when this crude was bought, margins were decent. We talk frequently about flat price with respect to Chinese imports. Are you talking about runs? Yeah, it can always be. I mean, runs can always be ahead of the Lunar New Year as well. That's one thing that is frequently talked about: higher runs before Lunar New Year. And of course, next month or the next couple of months, the state-run guys are going into maintenance, and there's reports that the Shandong players might start to run a bit more because they got a bit better access to the sanctioned feed and Russian HSR. So it's short term, I guess there might be net some pressure on Chinese runs from a maintenance perspective, but longer term, the signs are slightly better.
Good stuff. Okay, you picked up on Russia there. Russian refinery attacks, that's been in the news as well. Any thoughts around kind of the impact there?
They're picking up. These new long-range missiles look to be very effective, right? And we could spend all day talking about the place in this in terms of the peace talks. But for now, there's worries about Russian exports, right? The NAFTA market's definitely worried about it. It's going to be a multi-year low in exports from Russia in March, and diesel exports will be low as well, although partly it will be down to refinery maintenance, which is typically rising.
I just found it interesting that we saw this uptick over the last week or two in missile and drone attacks on various refineries in Russia, and then the ceasefire that gets talked about, the 30-day ceasefire, was specifically on energy infrastructure, which presumably would from the Russian side maybe include those. I know that energy infrastructure ceasefire was a suggestion that originally came from the Ukrainian side last year. So I'm not suggesting that this is targeted specifically at that, but maybe it helps in the short run to see those refinery attacks lessening a little bit if that ceasefire happens and does hold.
Yes, no, maybe, I don't know.
Let's just throw things out there,
Fair enough.
Stuff.
Okay,
attacks on infrastructure, everywhere it seems.
That's hard to forecast, to be fair. So wrapping up the week ahead then, have we got anything else that we'd like to add into that?
Well, the one other piece of news was the Trans-Niger pipeline, which has been partially blown up, seemingly, which is potentially worth another 200 kbd of basically Bonnie Light. So another piece of relatively bullish crude news. So it just goes on the list.
Yeah, goes straight into the physical markets then, and a bit of an impact to the light sweets, medium sweets there. So look, Neil, I'm going to keep you talking on this one then in that case. Let's move to physical crude. So North Sea crude is weakening that I've seen in the platform of late. So what's happening, and is it a short-term thing or is there something bigger that we need to consider?
Yeah, so there's a few ways to measure this, right? So the one is on ICE Brent spreads. Which looked like they were going to, they did start to weaken yesterday, but then they've kind of stabilized now, partly because there's flat price going up and down. But definitely you can see it in terms of the EFS, or the Brent Dubai swap, which is kind of the EFS has turned negative. And don't want to be too sort of overt about it, but we did kind of call this thing on Monday. It seemed like that needed to happen, and there's a few reasons. So from the ARB perspective anyway, right?
Yep.
So just to list it off, early Q1, the North Sea crude and European crude was arbing nicely east, as we know, and that flow has likely stopped because the ARB has been completely closed. And the other major problem is TI is seemingly struggling to clear in Asia. And the long and the short of it is TI is competing with Murban in Asia. Murban's quite cheap in Asia. TI needs to get cheaper, and that's what it's been fighting to do against Murban in the east. And as a result of that, it's landing really cheap in Northwest Europe. And so the diff between the landed value of TI and 40s in Northwest Europe is bigger than I think I've anecdotally sort of in the back of my head observed since we started this crude tool. So TI, if you had to put a number between 1 and 10, is definitely a 1 in the North Sea just now in terms of how cheap it is. And on top of that, you have weakening margins, particularly in the east, but also in Northwest Europe. On top of that, you have turnarounds. On top of that, you have the highly visible data of US crude stocks building. So that is basically what the call kind of was on Monday. This looks bearish, and particularly on Brent, because if TI can't clear into Asia, it's going to be dumped into Europe, and that basically is it. And that started to look like it was happening on Brent spreads. I can't see it in the physical FOB premium yet, but I still think
a little bit, don't they?
Yeah, and I still think that that's the outlook for the foreseeable. I think it's sort of started to emerge in the DFL as well recently, and that's the main problem with the North Sea. I still think it's kind of a bullish setup beyond the next few weeks, but the short term, it looks like North Sea needs to weaken and possibly even more.
Yeah, fair enough. So keeping an eye on kind of your FOB prices there and see what that looks like kind of going into next week then in that case. And you're right, there is still quite a lot out on maintenance that should be coming back. So that might kind of in the next couple of weeks tighten that a little bit. But it looks as though there's a lot of crude around for sure. So look, you touched upon kind of TI struggling to compete in Asia against Murban. Does the weak freight demand confirm that the US crude flows to Asia are slowing? I kind of want to talk about this more around kind of the Asian cracking margins and a bit more. And I think, Phil, I'm going to pin you on kind of refinery margins at the end of this, a bit bigger as well. So
yeah, so we've already explained that TI is looking struggling to clear. We'll keep an eye on that, and the Asian margin problem looks to be much more of a problem now, particularly in Asia versus Europe. So it's a kind of a confluence of factors. But two things to add. There could be another couple of reasons why TI is struggling. The first is, of course, the sort of 200 KBD that has been removed from China because they've put a tariff on WTI. So that's 200 to keep in the back of your mind. And then something that June has been doing some detective work today and yesterday in terms of the Exxon Singapore refinery, which has just announced its the startup of a new residue upgrading unit, right?
Okay.
And I think that was a very regular buyer of WTI, I think 2 to 4 VLCCs a month. And basically they have stopped buying and they're going to move to something like Al Shaheen because of the new residue upgrading. So that's another, let's say, 200 KBD of TI demand loss. So that's actually quite a big volume when you think about it, just from that alone. And that needs to clear somewhere else in Asia. So it's kind of no wonder that TI is struggling price-wise, let's say.
Yeah, that's quite a lot of volume if you add up the China and the Exxon kind of piece and then switching to heavy crude, right? Okay, all right. So all kind of leads back to kind of Northwest Europe. Keep an eye on kind of your cash diffs there for some of the crudes over the next week. But Neil, if I was to pin you on anything, what do you think your trades would be now?
Yeah, it looks kind of more bullish, the Dubai market, partly on what we've been saying, partly on there's reports that Chinese want to turn to more sour crude, Brent pressure because it needs to find some outlets. So I still think short-term DFL, short-term possibly ice Brent spreads if it gets desperate enough, although obviously that gets chucked around with flat price. So if there's a new tweet or something like that, it's more difficult and tend not to. I've tried to talk about trades on ice Brent spreads before in this podcast and I always get it wrong. So, but it's good directionally to talk about this stuff at least.
I think the sentiment is quite important from you, Neil, to be fair. So
just like, these are the things that would lead me to analyze this direction. Whether or not it turns out, I don't know.
Fair enough. Anything else in the short term? So as I said, bullish supply demand factors on the horizon, maybe. Phil, Neil, anything more that you want to add into that?
Yeah, I still think I'm relatively bullish crude in Q2. The end of TARS. US stocks are building, of course, but it's nothing that's outside of the norm seasonally speaking. And US stocks of products are drawing nicely. So there's nothing that's particularly bearish in the US. And then the other thing, which is a good segue for Phil, maybe you want to do the gas oil section first. I definitely think the gas oil crack is undervalued because now you're seeing Asian refiners struggling at the margin. And we know that the gas oil crack sell-off has been macro driven largely, right? And if the problem is Asian margins and we're not particularly bullish east-west for various reasons as you can go into, then the solver for me is overall gas oil cracks that need to go up again.
James is going to be delighted to hear you being bullish, Distillate, to be fair. I'm disappointed that he's not here to kind of listen to this. But Phil, you're on the hook for both gasoline and distillate today. And as Neil has kind of kindly segued in, do you want to do distillate first then?
Well, I would just because just to talk about those kind of bullish factors and to hark back very quickly to the stats that we've been seeing, there is a very nice kind of gasoline days demand cover in Europe chart that Neil put together, which is very low, which is kind of goes into a similar narrative that we've been hearing in terms of the observed weekly ARA gasoline inventories still very high. Apparently, I think we'll find out today or tomorrow. Is it today or tomorrow? The next kind of update on those, but have been very high, and that's been kind of one of these stories that has been keeping EBOB in particular relatively subdued, but the broader European gasoline picture, so the stocks outside of those highly visible ARA tanks that are reported, not so high. So that kind of dichotomy still exists apparently.
Okay.
And
so
there was and then obviously on the last bit then where Neil also mentioned that that margins in the East in particular not looking fantastic. That is also partly diesel crack driven, but it doesn't really matter, I suppose, what is driving those margins lower. It does look as though that those kind of simpler setups, especially in the East, are going to be maybe struggling for utilization come maybe April, May.
Okay. All right, Phil. So where do we want to start? Do we want to start on the distillate side of the barrel or the gas side of the barrel?
Let's follow up with diesel. That's fine, because it's always nice to talk about a whole raft of various bullish impetus. That being said, as a little sneak peek, I'll get to gasoline, and I'm also looking pretty bullish when we get to EBOB as well. There's plenty to be excited about there.
Brilliant. So. Back on the EBOB bandwagon. God, this is a really positive kind of podcast. I mean, Q2 kind of crude, positive, bullish sentiments. Look, diesel and jet markets are definitely turning bullish again, by the sounds of it. So how much of this is due to supply risks from the Houthi strikes, Russian refinery outages, and tighter arb flows into Europe? Then I think there's like 3 questions in one there for you, Phil.
Yeah, no, it's great. So, I mean, obviously, Houthi strikes and a kind of breakdown of the ceasefire in Gaza is kind of rolled into one, essentially, just to, as we said at the beginning of the podcast, cut off the prospect of a return for the Suez routing, which adds that kind of baseline east-west change, which means that the east-west, as it is at the moment, is anyway pointing decidedly east. We had a moment, I think, a couple of weeks ago maybe, where it narrowed to a certain extent, and some of those swing barrels from AG, India could move west, and maybe that still now kind of filters into a April arrivals European gas oil market. We've also had a lot of points over the last week or two where the Gulf Coast arb into Europe was kind of flashing open as well. So I think for kind of early mid-April arrivals, we're probably still relatively well supplied. But looking beyond that is where we can really get then, a bit more bullish on European diesel, especially. So obviously lower Russian supply goes into that. The fact that those Gulf Coast arbs are no longer pointing to Europe, but pointing to LATAM, possibly also linked to the lack of Russian supply. So beyond kind of April gas oil expiry, we're starting to look much better, both on a relative arbs into Europe perspective, but also just on a broader, maybe a supply perspective as well, given that cracks are a bit lower.
Brilliant. I think we've got a refinery shutdown in there as well, haven't we?
So Vesseling, yes, and then in a couple of weeks it'll be Grangemouth as well. I think specifically on Vesseling, it'll be interesting to see whether that impacts the pricing center. So whether that impacts ARA in particular, because there's going to be more of a pull out of ARA inland. So those kind of barge markets are likely to pick up in terms of overall demand there. So maybe the pull into the pricing center can have a bit of an impact there as well. Yeah.
Okay, we'll double check that one then. And yeah, as you mentioned, Grangemouth is shut in as well in Q2. But we mentioned it last week. We have been having conversations around whether there's merit in keeping that open with kind of US sanctions. But I think that's a bit of a kind of dead duck, to be honest. Okay,
and
so
it filters into gasoline as well. Yeah.
Sorry. Yeah. No. Good segue. I was going to say less. Very keen. Kind of. Obviously, we've got, as I said, James is going to be delighted that we're all on the same page with being bullish distillate, which is great. But look, on gasoline, you spoiler alert, you're looking at EBOB again. So TA arbs at their strongest levels. So look, how sustainable is this, given the blending margins and pad 1 inventories as well that you've been looking at?
Yeah, so obviously the biggest driver, it seems, recently or at the moment is the Bayway Linden maintenance that's obviously going on at the moment. So that's 140 kbd potentially of gasoline at the high end, maybe that's missing from pad 1, and so it is justified to see a very open TA arb at the moment. And the fact that it's open also in our calculations for ARA blenders typically isn't sustainable. So we have these kind of three levels of margin calculation, and when the blender margin opens, I typically describe it as essentially kind of, anyone and their mum can start buying up components, blend them together and ship them over. It's a little bit more complicated than that, but
it's our highest degree of confidence.
It can be a bit of a free for all, especially when the blender margin goes above 1 cent per gallon, for example, where it is now. So it's almost never sustainable. But I would kind of caveat that at the moment, at least for the next couple of weeks, by saying that we do continue to see these elevated kind of ARA, at least gasoline inventories that are reported. We do still have another few weeks of this of the Bayway maintenance to go. And we do still have that kind of looming threat potentially of tariffs. Whether that doesn't really matter on who those tariffs are going to be. It would hurt Pad 1 supply. So it looks as though the market is trying to supply Pad 1 as best it can at the moment. So maybe rather than the blender margin only open for a few days, maybe it can be open for a couple of weeks. But our kind of the forward pricing at the moment also sees that TAR very wide and open also into kind of May loaders out of Europe, and so kind of into June arrival at the moment, and that looks a little bit overdone. So April very much open, maybe justified, at least the first half of April. The fact that it's still open beyond that is maybe a little bit of a first sign that we get pricing's got a little bit carried away on the TAR in particular, and that maybe for May RBOB, it's a little bit too high. May EBOB therefore a little bit too low.
Yeah, fair enough. We discussed it last week. You talked at length about US Gulf Coast and the component markets for that. So I kind of want to catch up just to see if there's much change around that. And that'll probably lead us into, how did we actually get here on the TAR in the first place? You touched upon Bayway, but what can we add to that?
Yeah, so a lot of what we were saying over the last couple of weeks in terms of the Gulf Coast components markets was that they were relatively weak. It seems the premiums were very, very weak, and that opened up the A and M grade kind of blend margin in Houston. So so blenders could also get involved in what is typically a kind of refiner owned and run wholesale market. And that has helped to bring up those blend costs in the Gulf Coast, because a lot of the components, with the exception of MTBE, for obvious reasons, are not have been kind of bid up again. So what we were looking at, though, in terms of Gulf Coast versus ARA arbs, was that because the Gulf Coast was very competitive, that we would need to see a wider paper TA arb to combat that, essentially, and to allow ARA to export into some of these LATAM destinations. That TA arb is widened now. The arb is opened, and so the arb is opened. But it's also meant that as the Gulf Coast Premier have picked up, now ARA is very much the supply, the kind of swing supplier into LATAM destinations and into Pad 1. So, and that's why, if I go back to my kind of original, I'm getting a bit bullish EBOB, it's because April, May is still in contango, still in a kind of over $2 a ton contango for April, May, which is looking, I mean, okay, we've only got a week or a week and a half to kind of really price that properly, but I wouldn't be surprised if by the end of this month we are kind of closer towards parity at least. And looking also at May, June is at about $2 backwardation at the moment on EBOB. Now that is way lower than we've seen in any of the last couple of years, post-pandemic years. And even 2019, for example, that May June spread was more like $7 or $8. So we've got a long way to go between where we are now and where that May June spread typically ends, April. So given that there's a lot of demand, or there's a lot of arbs that are open out of Europe at the moment, and we are going to start, European demand is going to start picking up. We're going to start drawing on those inventories eventually. I think that kind of May June $2 looks pretty ripe for a bit of a correction to the upside.
I think, Neil, you look as though you're about to kind of interject here.
I've just put my hand up in Teams and I've just posted a chart into the chat. Just the thing to add on, Phil. So injecting a slight amount of fundamentals in here, like an alternative indicator of what you've just been saying. One of the things I like to do with the EIA data is try to gauge the relative strength in stocks between pad 1 and pad 3. So that basically says how far away is pad 1 stocks from the seasonal average, how far away is pad 3 stocks from the seasonal average. And we're right at close to the top end of the range as it ever gets in terms of the relative difference between pad 1 and pad 3. So pad 3 stocks are tight and pad 1 stocks are kind of ample. And that kind of chimes with what you've just been saying about pad 3, right, Phil?
Very much so. So it looks as though it makes a lot of sense fundamentally for ARA to need to export both into pad 1 and into LATAM. And it looks as though, the Gulf Coast has it's reasonable that Gulf Coast components market needs to bid up. It needs to be kind of a bit stronger now because there's no real kind of fundamental justification for them to need to export much.
Got it. Okay, well, look, that rounds up kind of TA and the US. Anything interesting kind of going on in the Singapore markets?
Yeah, so the East of Suez gasoline market has been an interesting one because we've gradually seen Singapore strengthening. And what that is doing is it's taking out potential Singapore export markets. So not long ago, we saw Singapore open into places like Pakistan, kind of going west from Singapore, or into West Coast Mexico, for example. And both of those have now been replaced essentially by either the AG into Pakistan or by the Gulf Coast into West Coast Mexico. At the margin, we even see some potential for ARA barrels to move into Australia, at least for a few windows, if you can find an LR willing to do it. And so normally that would mean that we should be seeing kind of a ceiling or even maybe a little bit of a correction on Sing spreads. But I think at the moment it looks as though there's kind of some justifiable supply tightness around that market. So Chinese exports have been look as though they have been weak at the beginning of the year, and there's nothing in their kind of proxy export margins that would suggest that should pick up now. And we have obviously kind of ongoing maintenance and some unexpected outages, like an RFCC in Taiwan, for example, which should keep that market relatively tight now. So our picture out of Singapore, not so great, but supply picture also not fantastic. So probably a little bit of a justified tightness to continue there.
Okay. I want to kind of delve into refinery margins because that's been kind of changing over the last couple of weeks. So keen to get your views on this. So let me pose a question to you both then in that case. So our current crack spread sending the wrong signal to refiners during this maintenance season. We talked about being bullish kind of across the light ends complex. So what are we thinking here?
Yes.
Oh,
wrong signal.
Simple.
Correct.
Yeah. Good stuff.
But
look, we're coming out of maintenance. So where do we go from here?
Well, I think if we break it down, like one way is to break it down by product, right? I think we're kind of maybe not very short term, but fairly short term turning bullish, particularly European gas oil.
Yeah.
And it sounds like Phil's quite bullish on EBOB. So from the gasoline perspective, it makes sense. And that's the two things that really drive the cracking margins, right? We can talk about naphtha and fuel oil, and the high sulfur market looks a bit shaky, as our colleague Hua was writing about through the week. But, that's not the biggest concern from a margin perspective, let's say.
No,
so,
I mean, your biggest deals are your kind of middle of the barrel kind of light ends piece, right? So
yeah, and then from the crude premium perspective, we've just talked about North Sea, and we've talked about how cheap WTI is. So it looks like possibly European crude premium might come off a little bit. So that's also, all things equal, good for the margin. I think that's
pretty much it.
Right.
So
the only thing that I might add to that would be on the east, kind of because the east west, both on light and middle distillates, we have kind of more naphtha heading east now out of the med, and those swing kind of distillate barrels obviously very much pointing east. I'm not saying that the lower Singapore diesel crack is necessarily completely justified, but weaker than Europe on expected supply at least, and that has now pushed at least the indicator simple margin for Asia into negative territory. It's not been there for quite a while. So yeah, it certainly looks as though the Asian market's being told to run maybe at the margin a little bit lower, and that is maybe on distillates justifiable for a few weeks, months, but overall probably not.
What you're describing is east-west, though, and presume if we're getting bullish gas oil, it's kind of like, then what we need to do is see another move on east-west, to see another a sort of rebound on European premia, which have come off quite a lot in the last week, right?
Yeah.
And then what I'm talking about from the kind of fundamental perspective is we need cracks as the solver, and then we can decide on exactly where we put the marginal barrels via the east-west, for example.
Yeah.
I mean, ultimately, you have to try and chime these two things. There's slight differences in timing. Are we necessarily super bearish Q2 margins? Do we have anything to suggest that we need to be super bearish Q2 margins? I'm not sure. I don't think so.
No,
Nothing
I think
in the data so far.
Okay, so this is a fairly positive podcast then in that case. We've got kind of some great signals from Crude. We've got Phil, you're back on the EBOB Bandcamp being bullish. James will be delighted with kind of all of us for continuing the bullish run on European gas oil for sure. We potentially could see some strength coming back into kind of refining margins coming out of maintenance, given kind of if cracks kind of perform as we hope and predict that they will. So Phil, one last thing from you then. I missed you out earlier in terms of your 3 things that you're looking at kind of over the next week.
Yep. Okay. So that would be a ceiling and a potential kind of correction for especially May TARB, as led by kind of a bullish May EBOB picture. And then the other part of that would be that kind of maybe slightly counterintuitive to say it this way, but I think the TARB is overbought in the prompt and potentially oversold, or at least not strong enough later in the summer. So our forward TARBs, when you would expect more gasoline to be moving in July and August, don't look as though they are at levels that would actually support that yet. So kind of sell TARB in the prompt and buy it further down the summer.
Okay, good stuff. In that case, anything else from anybody else to add?
No, I think that's it. I mean, that's already enough for people to digest, I would say.
That's brilliant.
Until the next executive order.
Yep. So flat price keeps on whipping around, kind of headline driven, that's for sure. But I hope that gives kind of our listeners a bit more of encouragement kind of in positioning their trades heading into Q2 coming out of maintenance. Keep an eye on refinery margins. We will pick your brains next week, I'm sure, Phil, on EBOB. I'm very much looking forward to seeing the North Sea crude diffs come off a little bit. Neil, and let's not talk about your ICE Brent spreads trades. But if that's it, then thank you all for listening to this. Until next time.
Thank you. Cheers.
Thank you.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.